In part 1, we learned what index funds are and why they matter. But knowing what they are isn't enough. Most beginners fail because they don't know how to actually put them together into a portfolio that balances risk, return, and long-term growth. In this video, we'll build a complete beginner-friendly index fund portfolio, step by step, so you know exactly where to start, what to include, and why. The first thing to understand is asset allocation. This simply means how you divide your money across different types of investments. For index funds, it usually means splitting between US stocks, international stocks, bonds. Why this matters? Each type behaves differently. Stocks are higher growth but more volatile. Bonds are lower growth but add stability. Balancing them reduces risk while keeping long-term growth potential. Step 1. Choose your stock index funds. For US exposure, beginners often pick total market index funds or S&P 500 index funds. Total market funds cover large, medium, and small companies in the US's S&P 500 funds, focus on the 500 largest, most established US companies. Many investors combine both for broader coverage. Example, beginner allocation for US stocks, 70% total market fund, 30% S&P 500 fund. This gives growth across the entire US market while weighting large companies slightly higher. Step 2. Add international exposure. Next, you want to add international index funds to diversify globally. These track companies outside the US, protecting you from relying on a single economy. A common allocation, 20% of your portfolio in international funds. This gives exposure to Europe, Asia, and emerging markets. Step 3. Add bonds for stability. Bonds help reduce volatility. For beginners, a typical allocation might be 20 to 30% bonds depending on your risk tolerance. Higher bonds equal less risk but slower growth. Lower bonds equal higher potential growth but more ups and downs. Step 4. Decide on ETFs versus mutual fund index funds. You have two main ways to invest in index funds: ETFs, exchange-traded funds. Trade like stocks, flexible, intraday pricing. Mutual fund index funds, usually bought once per day at NAV, automatic investing possible. For beginners, both work. But ETFs often have lower fees, while mutual funds can automate contributions easily. If you want to build your portfolio the right way without guessing, subscribe now. We'll cover every detail step by step in this series, so you don't have to figure it out alone. Step 5. Keep costs low. Fees matter. Even small expense ratios reduce your long-term returns. ETFs and mutual funds both have fees. Aim for expense ratios below 0.1–0.2% if possible. This small difference compounds over decades. Example: investing $1,000 for 30 years at 0.1% versus 0.5% expense ratio can result in thousands more in your pocket. Step 6. Rebalancing your portfolio. Over time, your allocations will drift. Stocks may grow faster than bonds, changing your original plan. Rebalancing means adjusting your portfolio back to your target percentages. This keeps your risk level consistent. Step 7. Keep it consistent. The most important habit is consistency. Invest regularly. Don't chase short-term gains. Stick to your allocation. Rebalance periodically. This is how even beginners can grow wealth over time. Final insight. By combining US stocks, international stocks, and bonds thoughtfully, Keeping fees low and rebalancing regularly, you create a foundation that grows steadily over decades. That's the power of a well-built index fund portfolio.